We're taking a look at Twilio today. Shares continue to climb after reporting earnings on Wednesday. A beat across the board. Q4 guidance coming in above consensus. Joining us in a CNBC exclusive is Twilio's co-founder and CEO, Jeff Lawson. Jeff, welcome back. Always good to talk to you.
Thank you, Carl. Great to be back.
Street has definitely gotten a little more energized when it comes to the space and the prospect of maybe making a turn, a lot of hard decisions now out of the way. Is that how you see the narrative shaping up, at least right now?
Well, look, we've been doing a lot of hard work to take the business from its growth trajectory that we've been on, focusing almost exclusively on growth for the first, 10 plus years of the company's life, to build this amazing customer base of 300,000 companies and $4 billion of revenue, and now spend the last 12 to 18 months turning it into profitable growth. And we're really proud of the progress we've made. In fact, in just the last 12 months, we've seen a 17-point increase in our non-GAAP op margin and a 36-point increase in our GAAP margin as well. So we're very proud of the progress we've made in turning the corner towards profitability.
In classic Wall Street style, the market is appreciative, and then they're like, okay, how much more can we get, at least on the margin front?
What have you done for me lately? Absolutely. Well, we're very focused on balancing the needs of growth and of profitability, but very clearly we are showing that we can turn this business into a great profit-making, cash-generating machine.
How do you strike that balance? Because you've cut about a third of your workforce over the last year. How do you ultimately kind of catalyze things to the upside? I know you've got an AI product that you're working on, but with a smaller workforce, is it tenable in this environment?
Yeah, I don't think the size of the workforce is the main driver of our growth ambitions. Really, it's bringing great products to market, and you're absolutely right. AI is the potential to be a great tailwind for us. We introduced a couple of months ago customer AI, which is the notion of what happens when you take all these amazing new capabilities we're seeing with both generative and predictive AI, and you make it customer aware. You give it all the data about your customer base, who your customers are, what they're likely to buy, what they're not likely to buy, are they likely to churn or not. You give all this data to AI and allow it to start to optimize the customer journey, every touch point, from your marketing to your sales, to your service and support, to your product, your mobile apps. Like, AI will be able to optimize the journey for each and every customer in a tremendous way. And I think the result of applying AI to this customer domain will be that companies get 10 times better at serving their customers. And they're going to do it at 1/10 of the cost of what they probably spend today to do that. And this is going to completely revolutionize companies and how they approach their whole front office, all their customer operations.
So to that degree, does it really matter about the consumer macro backdrop? And I guess whether or not it does matter to those companies and their margin improvement, how concerned are you about the U.S. consumer rolling over?
Well, we have a usage-based pricing model for most of our products. And what this means is that the more of our products that our customers use, companies who are customers, the more money we make. Now, this was great during a period of great economic growth for the last, say, decade. This propelled us to very high growth rates and dollar-based net expansion rates and things like that. Now, granted, it's been a headwind during the last 12, 18 months, no doubt about it. But the way I look at it is we now have a streamlined cost structure to our company. And as the macroeconomy continues to change, and eventually it will come back to more growth, right? And as it does, that growth will turn into more usage of our platform, more revenue, and that gross profit will fall very rapidly to the bottom line of the company because we don't have to spend more to get it. So we can be the beneficiary of positive changes in the macro economy. I think we've taken most of the punches already in terms of the downsides of the macro economy over the last 12, 18 months. And so we're looking at it as the opportunity for upside going forward.
Most of the punches, do you think that you've seen the trough? It's in the rearview mirror?
I can't say for sure. Obviously, I don't have a crystal ball about the macro economy, but what I can say is, we've been working very closely with our customers. We've seen a few verticals where we've seen more headwinds. A lot of verticals, though, we think are very healthy. And so we continue to work with our customers on it. But I think for the most part, I'm optimistic about where the world's going.
Finally, are you guys getting more aggressive on marketing spend, or how do you approach that going into, say, an election cycle?
Well, we tend to look at marketing spend or any spend that we do and look at it in terms of ROI. And is it turning into more customers or customers who are more likely to spend more? And when that happens, we'll be likely to spend more. And if that's not happening, we'll retool and spend on things that gain better ROI. So, I think we moderate it in any environment for the ROI.